How is the tightening of bank lending impacting the United States commercial real estate market? Welcome to the Commercial Real Estate Insights podcast. I'm your host, Steve Hamoen. Let's get right to it. The United States commercial real estate market is facing one of its most significant challenges in decades. A confluence of factors including high interest rates, evolving work habits, and a noticeable reduction in bank lending is creating a slow-moving credit crisis across the sector. Commercial real estate loans, often structured with maturities of 5 to 10 years, typically require refinancing upon maturity. However, since the Federal Reserve began increasing interest rates in 2022, banks have become more cautious, choosing to refinance only the most robust properties, those in prime locations with high occupancy and strong cash flows. This cautious approach by banks leaves many office buildings, older retail spaces, and underperforming mixed-use developments struggling to find traditional refinancing options. These non-prime assets are increasingly turning to private credit markets, which come with significantly higher interest rates. Borrowers are now facing rates between 11% and 18%, depending on the perceived risk of the asset and borrower. For investors and property owners accustomed to 3 to 4% debt, these new rates are not only painful, but unsustainable, leading to decimated margins, and, in some cases, a complete evaporation of positive cash flow. The office sector is particularly vulnerable, as it continues to deal with reduced demand due to remote and hybrid work arrangements. National vacancy rates remain high, and property valuations in urban centers like San Francisco and Chicago have dropped as much as 40 to 50% from their pre-pandemic highs. Recent actions by major financial institutions underscore the crisis. Dutch megabank ING recently sold one of San Francisco's largest office towers at 75% less than its 2019 value, resulting in a loss of $545 million. Similarly, JP Morgan, Goldman Sachs, and Capital One are offloading billions in office-related debt, which not only signals broader industry weakness, but also actively resets property valuations downward. As banks limit their exposure to rising defaults, many borrowers find themselves without institutional refinancing options, leading to distressed asset sales and declining property values. The current environment is bifurcating the market, where only high-quality industrial and multifamily properties in strong locations can still secure bank financing, often requiring new equity injections or at higher rates. Meanwhile, Class B and C properties, those in secondary cities or with weaker tenant profiles, are effectively cut off from traditional financing avenues. This creates a precarious imbalance, with only the best properties surviving, while others are forced to resort to high-cost private credit or liquidation. The situation stifles recovery by limiting capital access to potentially viable but underperforming assets. The commercial real estate market's correction is not solely about falling values. It is about liquidity. Real estate depends heavily on debt, and when that capital flow dries up, even fundamentally strong assets can struggle. The slow pace of refinancing, coupled with elevated rates, is choking cash flow and triggering fire sales. Many analysts believe the sector is entering a prolonged period of deleveraging, marked by more distressed sales, write-downs, and a reduced appetite for risk among banks and institutional lenders. However, this also opens the door for strategic investors and private credit products to step in, offering both capital and structure in a dislocated market. In this tightening credit landscape, structured investment opportunities like the AccretivPLUS Healthcare Portfolio TI Note from OrbVest SA, proprietary, limited, present a compelling alternative. This 12-month fixed-income debt instrument offers a 9% annual return, backed by a portfolio of United States medical office properties, an asset class with strong long-term fundamentals. Unlike general office properties, medical offices benefit from stable demand, long leases, and recession-resilient tenants. The AccretivPLUS TI Note is secured by over $200 million in assets, including $80 million in equity, offering a fixed return for investors seeking stability amidst the current commercial real estate volatility. The United States commercial real estate market is not collapsing overnight, but it is undergoing a gradual recalibration as traditional bank credit becomes scarce. Refinancing challenges, soaring private credit costs, and valuation pressures are reshaping the landscape. Investors and property owners must navigate a new era of higher rates, selective lending, and increased risk. In this environment, alternative debt products, especially those backed by resilient sectors like healthcare real estate, offer an attractive risk-adjusted return. As banks retreat from commercial real estate lending, opportunities like OrbVest's AccretivPLUS TI note provide investors with both yield and stability in uncertain times. Nicole S. Prano reports that NAI Nashville Stanton Group has commenced the development of the Margin District, a new project in downtown Franklin, Tennessee. This ambitious $165 million mixed-use development is currently seeking retail tenants to occupy its street-level spaces. The project, located at 805 Columbia Avenue near the city's 5 Points, will feature 25 luxury homes and approximately 50,000 square feet each of retail and office space, culminating in a total of around 180,000 square feet upon completion. Although the Margin District is outside Franklin's Historic Preservation Overlay District, the developers are committed to incorporating architectural designs inspired by the city's historical aesthetics. The project will feature elements such as antique brass, stepped roof lines, dormers, and gabled upper floors. Nashville-based Studio 8 Design is the architect of record, with Niket Architecture and Design from Birmingham serving as the design architect. The development is a collaboration between NAI Nashville Stanton Group and Arlington Family Offices, which operates in both Franklin and Birmingham. Arlington acquired several properties for this project, including the former Handy Hardware building, which was bought in 2020 for $4.8 million. This building will be restored and integrated into the new development, maintaining a connection to Franklin's rich history while supporting quality growth. Significant planning and zoning changes have been made to accommodate the new development. The Board of Mayor and Aldermen and the Franklin Municipal Planning Commission approved amendments to the Envision Franklin Plan and the zoning ordinance, allowing the new buildings to rise up to 3 1/2 stories. This includes a requirement for the upper stories to be stepped back from the lower stories, preserving the visual character of the area. The residences, located on the 3rd floor of the new buildings, will offer between 2,000 and 3,000 square feet, each with a private terrace and secure parking in a gated garage. Reservations for these homes started in November 2024, with prices beginning at about $2 million. Friedrich & Clark Realty is managing the sales, and 13 units have already been pre-sold. Some residences are expected to be delivered by 2027. Julia Etchickson reports that Continental Realty Corporation, based in Baltimore, is expanding its portfolio to South Florida with a recent acquisition. The firm has purchased the retail component of the City Place Doral mixed-use development for $87.5 million. This retail center, located at 8,300 Northwest 36th Street, is about a mile west of the Palmetto Expressway and 2 miles from Miami International Airport. It spans 235,000 square feet and is anchored by a grocery store. Currently, the property is approximately 80% leased, hosting 30 tenants, including the Fresh Market, Cooper's Hawk, Oakberry, and Anatomy Fitness. The City Place Doral development, completed in 2017 by Miami developers Related Group and Shoma Group, encompasses an 18-acre mixed-use campus with a 303-unit multifamily component. PGIM, an insurance giant, previously controlled the retail portion before selling it. The transaction marks Continental Realty Corporation's first acquisition in South Florida, aligning with their strategy to acquire irreplaceable assets with necessity retailers in thriving retail corridors. Josh Dinstein, Senior Vice President of Commercial Acquisitions at Continental Realty Corporation, stated that the center is situated in a growing submarket with high barriers to entry and a market occupancy exceeding 97%, making it a valuable addition to their portfolio. The acquisition was financed through proceeds from a $323 million fund. This move reflects the firm's focus on retail and multifamily properties, managing over $4 billion in assets. Additionally, more retail development is anticipated in Doral. Codina Partners recently secured a $39 million construction loan for a retail expansion as part of the final phases of the 250-acre downtown Doral master development. Such developments highlight the ongoing growth and investment in the Doral area, reinforcing its position as a key retail and residential hub in South Florida. Vestar, a leading privately held owner and operator of open-air shopping centers in the western United States, has been engaged by Nuveen Real Estate to provide property management, strategic leasing oversight, marketing, and construction management services for its newly acquired retail portfolio in Southern California. This portfolio is grocery-anchored and consists of over 600,000 square feet of high-performing shopping centers, with occupancy rates exceeding 98%. The portfolio includes several prominent centers: River Oaks Shopping Center in Santa Clarita, Campus Marketplace in San Marcos, the Pavilion at La Quinta in La Quinta, Bear Creek Village in Wildemar, and Old Grove Marketplace in Oceanside. Each of these centers is strategically located and anchored by major retailers such as Target, Sprouts, Ralph's, and Lowe's, serving densely populated residential areas and drawing consistent foot traffic. Patrick McGinley, president of Management Services for Vestar, expressed pride in being chosen for this significant management assignment, noting Nuveen Real Estate's reputation for excellence and successful investments. With this addition, Vestar's Southern California footprint expands to more than 8.5 million square feet, reinforcing its position as a leader in the retail real estate industry. The partnership between Vestar and Nuveen Real Estate highlights the ongoing demand for experienced property management and strategic leasing services in vibrant retail markets. As the real estate landscape continues to evolve, such collaborations are crucial for maximizing occupancy and adapting to market needs, ensuring long-term value for the properties. Vestar's track record of over 35 years in the industry, with a portfolio exceeding 30 million square feet across the western United States, showcases its ability to create vibrant shopping and entertainment hubs that transcend commerce to become essential community landmarks. This experience is invaluable in managing high-quality retail, entertainment, and mixed-use destinations. Alan Klein from the Washington Business Journal reports that Asana Partners is seeking a buyer for its 21-building portfolio located in Old Town Alexandria. This portfolio is noteworthy for its inclusion of several prominent retail tenants, such as Sephora, Five Guys, Patagonia, and Warby Parker. The properties, situated in a historically rich area, present a unique opportunity for prospective buyers interested in a blend of retail and historical significance. The move to sell this portfolio comes amidst a broader trend of reshuffling and realignment within the commercial real estate market. As investors and developers assess their holdings in light of evolving economic conditions, opportunities like this one emerge, offering the potential for strategic acquisitions. The presence of well-known retail brands within the portfolio underscores its appeal in a competitive market. This development aligns with the ongoing trend of investors focusing on high-quality, well-located retail assets that promise stable cash flows and strong tenant demand. As the commercial real estate market continues to evolve, deals such as this one highlight the dynamic nature of property investment and the continuous search for value in prime locations. Thank you for listening to the Commercial Real Estate Insights podcast. I'm your host, Steve Hamoen. See you on the next one.